Welcome to Trading Nation. I'm Dominic Chu. One of the market's biggest bulls is on correction watch right now. Ed Yardeni is concerned about market valuations and the impact of the coronavirus outbreak. The Yardeni research founder joins us now on the phone. Welcome to the show, Ed. As always, great to have you. Is coronavirus really the biggest threat to the market right now?
Right now, that's all I really see. The global economy was actually starting to show signs of improving before the virus became headline news. And now I suspect that the longer this virus threat continues to weigh on the global economy, the more it poses a risk for the, at least for a correction in the stock market.
So what exactly would drive that then? Why is it that big risk? What are the intricacies that we are either seeing or not seeing that could either cause that economic slowdown or potential market impact?
Well, we saw the market going down on Monday quite a bit, and that was it. I mean, it wasn't much of a correction or a negative response to the virus because China's central bank started pumping liquidity into their economy, and we got a lot of good economic indicators out of the U.S. and also some of these purchasing managers. So the market's done remarkably well in the face of headline news that's still unsettling, like cruise ships being quarantined and China basically being completely quarantined because of cancellations of flights and all that. That's got to be disruptive for supply chains, and I would think that will have some negative impact on the global economy. But the U.S. Doesn't have much of a virus problem so far. Hopefully it won't have a problem at all. And on a relative basis, investors desperately want to be invested in stocks because yields are so low in the money markets and in the bond markets that they're chasing after dividend yields.
It doesn't seem, Ed, in that statement that you just gave, and I'm going to key on something that you just mentioned.
Yes.
It doesn't seem like there is much downside risk. Now, I say that a little bit tongue-in-cheek because it seems as though when there's the potential for a military conflict in Iran and Iraq, when there's the potential for a virus outbreak in Asia that spreads to other parts of the world, the one thing I hear more often than anything else is, don't worry, the central banks will get involved. But the central banks have never saved anybody from a disease, or have they saved anybody from really a military conflict? Why are central banks still a big focus?
Well, because interest rates are so extraordinarily low that there are a lot of people who have to have some income to live on or some income target that they feel they must have. And so if you're not getting much of a yield to do that in the money markets and in the bond market, then you're going to go to the stock market because that's where dividend yields are still around 2% on average, and where dividends tend to grow. So that's what's working here is the central banks have basically provided no interesting reasons to buy in the fixed income markets and lots of reasons to buy in the stock market.
It's the TINA trade, right? There's no alternative trade.
Yeah, I'm not a big fan of calling it the TINA trade because, you know, the bonds were a pretty good alternatives, and maybe even real estate's a pretty good alternative now. I think it's just reach for yield. I think it's that simple. People are looking for yield. It makes me a little bit nervous from a contrarian standpoint when I hear people saying that stocks are the new bonds, that if you can't get a good return in the bond market, look for it in the stock market. You know, when I say a correction, what I really want to convey here is I don't see a recession coming up here, and you know, all in all, a sell-off I would view as a buying opportunity. But I'd like to, you know, if I've got some spare cash, I'd like to just kind of keep it as dry powder until I get a little bit more clarity on this coronavirus.
All right, Ed, before we let you go, you mentioned the dry powder, the spare cash. Let's say some investors don't have that. Is now a good time to try to raise some of that dry powder or spare cash?
You know, I don't want to really be predicting corrections, so I'm really just predicting that we're still in a bull market, and I'm not too good at trading corrections. To trade a correction, you got to get out at the top and you got to buy at the bottom, and that's a pretty tough call. I think it's more important to stay invested because I think it's still a bull market.
All right, still a bull market for the long term. Ed Yardeni, thank you very much. Always great to get your insights. Thank you very much also for joining Trading Nation today, and thank you for watching. I'm Dominic Chu. We'll see you next time around.